Today we're diving into the bedrock of global finance, US Treasury Bonds. We're talking about the debt securities backed by the full faith and credit of the United States government that serve as the foundation for virtually every other investment on the planet. In 2024, Treasury bonds delivered mixed but significant returns, while the 10-year yield rose from 3.88% to 4.57%, creating capital losses for long-term bonds. Treasury bills crushed it with returns of 5.30%, outpacing many equity investments with zero credit risk. The bond market had a tale of two segments. Short-term treasuries benefited from high Fed rates, while longer bonds faced pressure from persistent inflation concerns. But here's the kicker. Treasury bonds aren't just about returns. They're about understanding the backbone of the entire global financial system. So how can government debt that pays relatively modest yields remain the world's most important investment? Stick around, because we're about to unpack how Treasury bonds work, why they matter to every investor, and what the unprecedented $34 trillion debt mountain means for the future. Let's start with the basics. A Treasury bond is debt issued by the US government, ranging from 4-week bills to 30-year bonds. When you buy a Treasury, you're lending money to Uncle Sam in exchange for regular interest payments and guaranteed principal repayment at maturity. It's the ultimate IOU, backed not by corporate assets, but by the government's power to tax 330 million Americans and the world's largest economy. Think about it this way. Imagine lending money to someone who controls the world's reserve currency and can legally compel an entire nation to repay the debt. That's what Treasury bonds represent. The closest thing to a risk-free investment that exists in finance. When analysts talk about the risk-free rate, they're referring to Treasury yields, which serve as the baseline against which every other investment is measured. The Treasury universe spans multiple maturities and types. Treasury bills, T-bills, mature in 1 year or less, offering yields that currently hover around 4 to 5%. Treasury notes mature in 2 to 10 years, with the 10-year note serving as the global benchmark, currently yielding around 4.18%. Treasury bonds stretch from 20 to 30 years, providing the highest yields but greatest price sensitivity to interest rate changes. Why do these seemingly boring government bonds matter so much? 3 fundamental reasons. They're the global safe haven, the pricing benchmark for all other debt, and the Federal Reserve's primary monetary policy tool. When markets panic, whether it's 2008's financial crisis, 2020's pandemic, or any geopolitical shock, investors flee to treasuries. This flight to quality can drive treasury prices up and yields down even when stocks are crashing. Treasury yields also serve as the foundation for pricing corporate bonds, mortgages, and virtually every other debt instrument. A corporate bond yielding 6% isn't evaluated in isolation. It's assessed as offering a 2% premium over comparable Treasury securities. Change Treasury yields and you change the entire cost of capital across the economy. The Treasury auction system represents one of finance's most sophisticated operations. Every week, the Treasury auctions billions in new securities through a process involving 24 primary dealers, major banks and securities firms required to bid on every auction. These primary dealers serve as intermediaries between the government and investors, ensuring there's always demand for new Treasury issuance. Picture this process. The Treasury announces an upcoming 10-year note auction for $40 billion. Primary dealers analyze market conditions, survey their clients' demand, and submit both competitive and non-competitive bids. The auction clears at a single yield that ensures all securities are sold. In 2024, direct bidding by institutions, bypassing primary dealers, reached nearly 18% of issuance, up from just 2.5% in 2008. The scale is staggering. Outstanding Treasury debt reached approximately $27.5 trillion by late 2024, with the government issuing over $22 trillion in new securities during the year. To put that in perspective, the Treasury market is larger than the GDP of most countries and represents the deepest, most liquid bond market in the world. But 2024 revealed growing strains in this system. The 10-year Treasury yield climbed nearly 70 basis points during the year, from 3.88% to 4.57%. This rise reflected persistent inflation concerns, reduced Federal Reserve bond purchases, and growing worries about America's fiscal trajectory. The Congressional Budget Office projects the debt-to-GDP ratio will reach 122% by 2034, a level that would represent a $22 trillion increase in outstanding debt. Foreign demand, historically crucial for Treasury auctions, has been waning. Foreign investors have reduced their Treasury holdings while domestic institutions, particularly price-sensitive buyers like hedge funds and asset managers, have had to absorb the increased supply. This shift creates potential volatility as these domestic buyers demand higher yields to hold longer-term Treasuries. The yield curve behavior in 2024 told its own story. For nearly 3 years, the curve was inverted. Short-term rates exceeded long-term rates, an unusual condition that typically signals recession fears. But late in 2024, the curve finally normalized as economic data remained firm and inflation persisted above the Fed's 2% target. The 10-year yield rose above 2-year yields for the first time since 2022, signaling changing economic expectations. Treasury bill performance highlighted the tale of two markets. While long-term bonds faced price pressure from rising yields, T-bills delivered exceptional returns of 5.30% in 2024. This reflected the Federal Reserve's elevated overnight rate of 4.33%, which kept short-term Treasury yields attractive throughout the year. For investors seeking safety and yield, T-bills offered both, a rare combination. The infrastructure supporting Treasury markets continues evolving. Electronic trading has improved price discovery and reduced transaction costs. The Fixed Income Clearing Corporation, FICC, processes about 75% of all auction deliveries, creating operational efficiency. Market liquidity, a persistent concern since the 2020 volatility, showed signs of improvement in 2024 as trading volumes increased and bid-ask spreads tightened. Treasury bonds serve multiple constituencies beyond individual investors. Central banks worldwide hold treasuries as reserves. Pension funds rely on them for liability matching, and banks use them as collateral for various transactions. The global demand for dollar-denominated safe assets has grown as international trade expanded and financial markets became more interconnected. Looking at historical context, current Treasury yields remain below long-term averages. The 10-year yield peaked at 15.82% in 1981 during the Volcker Fed's inflation fight. Today's 4.18% yield, while elevated compared to the post-financial crisis period, represents relatively modest borrowing costs for the government. However, with outstanding debt at unprecedented levels, even modest rate increases create enormous budget implications. The intersection of monetary and fiscal policy creates unique Treasury market dynamics. When the Federal Reserve conducts quantitative easing, purchasing Treasuries directly, it creates artificial demand that suppresses yields. Conversely, quantitative tightening, as occurred through 2022-2024, removes this support, forcing private investors to absorb larger Treasury supplies at market-determined prices. Risk management in Treasury investing involves more than credit considerations. Duration risk dominates. A 30-year Treasury bond can lose 20% of its value if yields rise just 200 basis points. This price sensitivity explains why professional bond managers carefully match duration exposure to their outlook for interest rates and economic growth. The global implications extend far beyond US borders. Treasury yields influence currency exchange rates, emerging market borrowing costs, and capital flows worldwide. When Treasury yields rise, it can trigger capital flight from emerging markets as investors seek higher returns in dollar-denominated safe assets. The dollar's reserve currency status amplifies these effects, making Treasury policy decisions globally significant. Future challenges loom large. Projections show debt service costs consuming an increasing share of federal revenues. Interest payments reached $880 billion in 2024, matching defense and Medicare spending. Climate change, demographic shifts, and geopolitical tensions all create potential fiscal pressures that could test Treasury market stability. Technology may offer solutions. Digital currencies and blockchain settlement could reduce transaction costs and improve market efficiency. Artificial intelligence in auction analysis could enhance price discovery. However, the fundamental challenge remains: balancing the government's enormous borrowing needs with investors' return requirements in an inflationary environment. Treasury bonds represent more than just government financing. They're the anchor of global finance. Every mortgage rate, corporate borrowing cost, and pension fund calculation ultimately references Treasury yields. The market's health directly impacts economic growth, financial stability, and investment returns worldwide. To wrap up, Treasury bonds transform America's borrowing needs into the world's most essential investment opportunity, providing the risk-free foundation that enables all other financial markets to function while offering investors the ultimate safe haven during uncertain times. They showcase how government debt, when backed by economic and political stability, becomes the cornerstone of global commerce and investment. The next time you hear about Federal Reserve policy changes or government spending debates, remember they're directly impacting the yields and prices of securities that touch every corner of the financial world. Every Treasury bond purchase represents confidence in America's economic future and participation in the market that literally underwrites global capitalism. What do you think? Would you consider adding Treasury bonds to your investment strategy? Let us know in the comments. And if you enjoyed this deep dive, give us a thumbs up, subscribe, and hit that bell icon. We've got plenty more content on monetary policy, government finance, and the markets that move the world. Thanks for watching, and until next time, stay informed and stay invested in the foundations of finance.